Hey there, everyone. Today, we're diving into a topic that's crucial for any business owner, entrepreneur, or anyone interested in the financial health of a company: inventory turnover. Now, you might be thinking, inventory turnover? Isn't that just accounting jargon? But trust me, understanding this concept can have a huge impact on how a business operates and its bottom line. So, let's break it down in a way that's engaging, relatable, and, most importantly, informative. First off, what exactly is inventory turnover? Simply put, it measures how many times a business sells and replaces its inventory over a specific period. Think of it as a gauge for how efficiently a company is managing its stock. The formula is pretty straightforward. Inventory turnover equals cost of goods sold divided by average inventory. Let's put this into perspective with a quick example. Imagine you run a clothing store. Over the year, you've sold $500,000 worth of clothes. This is your cost of goods sold, or COGS. If your average inventory during the same period was $100,000, your inventory turnover ratio would be 5. This means you sold and replaced your inventory 5 times in that year. Pretty cool, right? Now, why should you care about this ratio? Well, a high inventory turnover is generally a good sign. It indicates that your products are flying off the shelves, which means you're effectively managing your inventory levels. But what happens if you increase that turnover to 7? Suddenly, not only are you selling more, but you're also reducing your COGS to $350,000. Your gross profit jumps up to $150,000. That's a notable increase in net income and financial performance. But let's flip the coin for a second and talk about what happens when inventory turnover is low. Picture another scenario. This time, you're running an electronics store. Your COGS is $1,000 to $1,000, and your average inventory is $300,000, giving you a turnover ratio of about 3.33. Now, if demand drops and your turnover ratio slips to 2, you're only selling and replacing your inventory twice a year. What does that mean for your financials? Well, if your COGS rises to $1,500,000 due to that low turnover, your gross profit takes a hit and drops down to $500,000. Ouch! Low inventory turnover can lead to excess stock, increased holding costs, and even potential obsolescence of your products. Nobody wants to be that business sitting on outdated electronics that no one wants to buy. So, it's essential to keep a close eye on that turnover ratio. Now, let's talk about why organizations should aim for a higher inventory turnover. There are several compelling reasons. First, improved cash flow. When your inventory sells quickly, you have less cash tied up in stock, freeing up money for other investments. Second, reduced holding costs. Higher turnover means you're not spending as much on storage and maintenance of products that aren't selling. And who doesn't want to cut expenses? In addition, when your turnover is high, it typically indicates that your business is operating efficiently. This can lead to improved productivity, reduced waste, and ultimately, better profitability. On the flip side, a low turnover ratio can signal that it's time to reevaluate your inventory management practices. Are you holding on to excess stock? Are your sales forecasts off? But before you start making drastic changes, let's talk about some common accounting watchouts regarding inventory turnover. One major concern is inaccurate COGS. If you're not calculating your COGS correctly, it can throw off your turnover ratio completely. Seasonal fluctuations can also skew your numbers. If you have a holiday rush, your turnover might look great, but what about the rest of the year? Another thing to watch out for is misaligned industry benchmarks. Just because another business in a different market has a high turnover doesn't mean you should too. Every industry is unique, and what works for one might not work for another. And let's not forget about excess or obsolete inventory. If you've got outdated stock on your balance sheet, it can really mess with your turnover calculations. So, how can cost accountants help in all of this? They're the unsung heroes when it comes to monitoring and improving inventory turnover. By conducting regular analyses, they can identify trends and pinpoint issues. They can also help you figure out why your turnover might be low and recommend solutions. Maybe it's time to streamline your production process or improve your sales forecasting. Cost accountants can also monitor COGS to ensure accuracy, identify opportunities to reduce costs associated with inventory, and even help implement inventory management systems that keep everything in check. These systems can track inventory levels, forecast demand, and optimize production processes, which can make a world of difference in your turnover rates. So, what tools and processes should accountants use to keep an eye on inventory turnover? Well, first up, inventory management systems are a must. They provide real-time visibility into stock levels and can help forecast demand. Regular financial reporting is also essential. It allows accountants to analyze turnover ratios over time and spot trends. Sales forecasting plays a crucial role too. By predicting future demand, accountants can adjust inventory levels accordingly, helping to avoid excess stock. Optimizing the supply chain is another key area. By working closely with suppliers, accountants can ensure that inventory arrives on time and in the right quantities, keeping turnover rates healthy. And let's not overlook the importance of regular inventory audits. These audits help ensure that your inventory levels are accurate and up to date, preventing the dreaded excess inventory or stockouts that can really hurt your business. In conclusion, understanding inventory turnover is not just a dry accounting concept. It's a vital part of running a successful business. Proper inventory management can significantly impact your company's financial health. By calculating and analyzing inventory turnover ratios accurately, you can make informed decisions about purchasing and production, ultimately leading to a more efficient and profitable operation. So, whether you're a business owner or someone interested in the financial workings of a company, remember that keeping a close eye on inventory turnover can help you avoid stockouts, prevent overstocking, and boost your bottom line. Thanks for tuning in, and I hope you found this discussion on inventory turnover both engaging and informative.